So you've heard of options, maybe you've traded them before or you would like to, but you don't really understand what they are, how they're traditionally used, or how you can day trade them. Hey guys, I'm Tex. Today we'll be talking about all of these topics. If you're new here, I share my journey and experiences with trading and investing in the stock market. If you enjoy the video, please consider hitting the like button and subscribing to the channel. I'd also love to hear your thoughts or questions in the comments below. So what are options? Using options in the traditional sense is to think in terms of insurance. When we buy a home, we look to protect that investment with property insurance. We pay an insurance company a premium for insurance against things like fire damage, water damage, and more. In exchange for the premium we paid, the insurance company assumes a larger percentage of the risk. Any damages to our home is covered by the insurance company, and we've only lost the premium we paid plus any deductible. Without insurance, we assume all the risk and are responsible for the entire cost of damages. Stock market investors use options in a similar way in order to protect their portfolio. Let's look at a practical example. Say you bought 100 shares of Facebook at $200 a share. That's $20,000 you're risking. Basically, you're looking to pay someone a premium in exchange for assuming your risk. This is accomplished by purchasing put options, which appreciate in value if Facebook sells off. When buying put options, you effectively enter into a contract that gives you the right, but not the obligation, to sell shares of the stock at an agreed upon price on or before a particular date. You need to consider three things in order to ensure your $20,000 investment. First, you need to figure out how many put options will be required to ensure your investment. One put option is equivalent to 100 shares of the underlying security, so you only need one put option to cover your 100 shares of Facebook purchased. Second, you have to choose a price at which you want the right to sell shares of Facebook. This is referred to as the strike price. Finally, you need to pick a date when the contract will expire. If Facebook trades lower than your strike price by the expiration date, then you will have the right to exercise your put option. Every investor will have to decide when or if it's appropriate to buy insurance with options. Although their design is with insurance in mind, as traders, we still have access to trade the options market without having to own any stocks. When day trading options, we're looking to capitalize on volatility using the nearest expiration date. It is, however, important that we understand the product we seek to trade and how it's priced. If you want to make a directional bet on a stock using options, you can buy calls if you believe the stock will go higher, or you can buy puts if you believe the stock will go lower. This is referred to as a single leg option. As day traders, this is all we seek to trade. It involves more risk, but with that risk comes the potential for big rewards. It is also possible to short calls and puts. However, that involves unlimited risk without the proper strategy and is beyond the scope of this video. When you buy a call or put, you know exactly what your max loss is. Your loss can never exceed what you paid for the contracts. So if you buy one call on Apple at $1, your investment is worth $100 because we multiply the cost of the contract by 100. If that call expires out of the money, it will be worthless and you will only lose the $100 you paid for it. If, however, the call expires in the money, then your contract will be exercised into 100 shares of Apple. This could be a problem if you hold a position till expiration and you do not intend to exercise the contract. Although the max loss is known when buying calls or puts, most likely you never want to lose 100% of your investment. This is why it's important to understand how options are priced. There are three factors that impact the price of options. First is the cost of the underlying. Cost of the underlying refers to the price at which the stock or ETF underlying the option is trading at. In general, options will gain or lose value as the underlying stock moves up or down. Because we always day trade the nearest expiration date, the only thing to decide is the strike price for the option. For example, if Apple stock is trading at $200 a share, the 200 strike price for calls and puts is at the money. A 195 strike is in the money for calls because Apple stock is currently trading above $195 a share. However, the 195 strike is out of the money for puts because Apple is not trading below $195 a share. On the flip side, a 205 strike is in the money for puts because Apple stock is trading below $205 a share, and out of the money for calls because Apple is not trading at $205 a share yet. The second thing to consider is time decay. Options are a depreciating asset, which means they lose value every day and every hour until they expire. The decay is not linear, but rather exponential as the option moves towards expiration. When day trading options, it's important to understand that contracts can lose value from the time you bought them, even if the underlying stock is still trading at the same price it was when you bought the option. The biggest time decay will occur on the day of expiration. Most stocks have weekly contracts that expire on Friday, so trading the current day's expiration carries more risk and more reward potential. It can be safer to trade the next weekly expiration if you don't want to take the risk with contracts expiring that day. Finally, there is implied volatility. This is perhaps the biggest factor impacting the value of option premiums. When volatility increases, premiums are more costly because the sellers are taking more risk to ensure a buyer's portfolio. As day traders, we seek to capitalize from spikes and volatility to enter and exit trades. If Apple suddenly sells off with volatility, call options will lose value quickly, while put options will explode in value. The spikes in volatility can lead to much larger returns in options compared to trading the stock itself. Let's conclude with some basic day trading tips and strategies. So you can trade options with the same strategies you would use to trade a stock. We base trade ideas and risk off the underlying stock chart. Because options have three factors influencing their value, managing risk can be a challenge. Generally speaking, the more expensive the contract, the more dollar risk you're taking. While it may be tempting to search for cheaper contracts far outside of the money, this isn't always the best strategy. The ideal scenario is choosing a strike that is near the money in the direction you believe the trade will go. The further outside of the money you choose, the bigger potential reward and loss will be, especially on the day of expiration. It can also be helpful to consider the open interest for a particular strike. This tells us how many contracts are currently open at that strike and expiration. Volume is another metric that's useful in order to determine which strikes are trading the most contracts. This will help you find more liquid strikes that are likely to have tighter spreads, especially when trading more expensive contracts such as Amazon. So that's going to do it for this video today, guys. Hopefully it was helpful if you ever wanted to learn about options, what they are, and how you can trade them. If you have any questions at all, please leave them below and I'll make sure to get to each and every one of you. I want to thank you guys so much for watching. Please like and subscribe and share the video if you did enjoy it. I really appreciate all the support and wish you guys all the best. This is Tex signing off. Until next time, take care.